Well, happy Monday, everybody. Stephen Sitkowski here, and I just felt really compelled to provide you a little bit of commentary and update today on what is going on in the financial markets. Things are crazy, and they have been for the last week or so, and I've just had lots and lots of people who have reached out to me, and it's like, what's going on? Why are we getting all this market volatility and so forth? And so I thought I'd try to address all of you kind of at one time. So for those of you who are new to me, I am the co-founder of Market Mastery Group. I'm the founder of Sitkowski Trading Academy, and I have dedicated decades to teaching people like you how to be able to navigate the financial markets, make money regardless of whether markets are going up, down, sideways, calm, or volatile, teaching people how to look logically at the marketplace. And if you'd like more help with that, be sure and just let us know. We have some great education for you. But let's focus on what's going on in the market right now, shall we? First of all, tons of recent volatility, pretty significant pullback. And the bottom line is, I frankly think that we got a little over our skis, as we like to say. The market got ahead of itself. And just generally speaking, anytime you see a big sustained up move, there's always going to be a consolidation at some point. You're never going to get a parabolic rise that goes on and on and on and on and on. So essentially, this year, the market, beginning in February, pulled back about 35%. And then it caught all the way up, even though we're dealing with all of these socioeconomic issues. And quite frankly, it really didn't make sense. This market has been a mystery to a lot of us who have been studying the market for years. And the only thing we could come up with is the fact that the Fed and the Treasury are just throwing money, like trillions, at people to go out and spend. So clearly that is going to help. But there was big concern over the market being overbought. The PE ratio last week was 21, as if things were normal. That is a strong above average PE. How can you have an above average PE with 14% unemployment and potential spikes going on with COVID-19? And that's the other thing that's created a lot of volatility. It seemed like the whole COVID-19 case or coronavirus case or whatever the hell they're calling it today. It's weird that in our country and in our lexicon, we have to keep changing names for the same thing. But in any event, it sort of felt like we had a lid on it. Cases were starting to drop. Then our eyes were diverted because we were dealing with all of the social issues and protesting and all of that unfortunateness that probably was required in order to just generally teach people that everybody should be treated the same, everybody has equal value, etc. And we're not going to overindulge in that. But we stopped talking about the virus. Well, the virus is back. I know that the number of cases since Memorial Day in Arizona have doubled. COVID is spiking in Utah, which is my state, Texas, Florida. And we always knew that once we put people back out into the workforce and we got people together in groups, that this was a possibility. Bottom line is, it is happening. And it's surprising that it would be spiking in the summer. It's a little scary. And so, investors who are always looking ahead are thinking, well, what happens if we have to go back in and close businesses down? Can the economy handle that kind of a double hit? And so people are selling stocks. We have Jay Powell, the chairman of the Federal Reserve, is headed to Capitol Hill, and everybody's wondering, what is he going to say about the economy? Last week, he came out and said, we don't think we'll raise interest rates for years. All right, so let me tell you what he's saying. We don't think the economy is going to get better for years. And instantly the market responded to that in a negative way. On the other side, the economy in some sectors is rebounding. And here's the weird part. It's like we're walking this tightrope. We want the economy to get better, but we don't want it to do so well that the government is no longer willing to put more money into circulations. The markets are looking for at least another trillion in stimulus. And we're having a rebound in retail, home building. People are going to work. You know, recently we added 2.5 million jobs, which was great. We were expecting to lose 8 million. But then maybe Chairman Powell says, I don't think that we need much help. And Congress says, I don't think we need much help. Another bit of conversation that is taking place right now in Congress. So unemployment is a weekly check that comes from the state. On top of that, the Fed is giving people another $600 a week. And so there's a whole bunch of people making more money not working than working. And so they're reluctant to go back to work. So as a result, this $600 a week is supposed to end at the end of July. And it was assumed they would just continue that because it's what's keeping the economy alive. And now there's talk that they're going to discontinue it. So there'll be definitely a debate on that. Big question is, and we're going to take a look at a chart in a moment, are we going to be able to hold support levels? And we're getting dangerously close. Will OPEC hold firm on their production cuts? So they've agreed that they're going to reduce the production of oil by 9.7 million barrels a day because we can't have oil prices dropping below $30 a barrel. Basically, you'll put the oil industry out of business. And in the United States, we have 10.3 million jobs tied to that. So we'll see if they all behave. And this is just generally a tough market in which to take trades. And so my words to you are, be cautious. Make sure you are hedged. So how do you hedge? You can place put positions on your equity. So a put option is a kind of insurance. And basically it guarantees that regardless of what the price of a stock does, that you're going to get a certain minimum price. And then you might want to consider looking into a leveraged inverse ETF, and I've got one for you. It is T like Tom, Z like zebra, A like apple, TZA. TZA goes up when the market goes down. So if you were to put some of that in your portfolio, if the market drops, the idea is you can help offset some of your losers on your equity positions with gains from TZA. All right, so let's check in. And let's look at a chart, see where we're at right now in terms of support levels. All right, let's go to the SPY. Pull this up. Okay. Let me get rid of these moving averages just to clean it up and make it easier for everybody to see. And then I'm going to add one back in. All right. So where are our support levels? So there's a couple of them. So you're looking at the SPY, which is a proxy for the S&P 500. The S&P 500 is one of the indexes that investors look at. So we have kind of a couple of different levels. One we're sitting on basically right now. The next one is down here. And then beyond that, down here. If we fall below 280 or 2800 on the SPY, look out below. Okay, so we've got a couple of support levels left to hit. So far we're still in decent shape. And in fact, if we wanted to draw a trend line, we're kind of sitting right on the trend line. We need it to pop back up to get a little bit of breathing room. So things are teetering. The economy is teetering. COVID is teetering. The charts are teetering. I call this an inflection point. Let me also show you, speaking of levels of support, let's look at a 50-day simple moving average and see where we are relative to that. Okay, so the good news is we are still above the 50-day. So the 50-day is at 290, which is one of those support levels that I shared with you. I also keep an eye on the 30-day. We can see we're sitting right on the 30-day. So if the S&P 500 breaks below its 30-day, it's not considered super critical. If it breaks below the 50-day, now you're drawing the attention of big institutional investors, the ones that have all the money, and they tend to sell into that kind of a break. So bottom line, a lot of stuff going on right now. Very difficult market to trade. I want you to be careful. Be careful. Keep an eye on current events. You know, tune into CNBC every now and then. You can do it online or you can watch it on your television set. And then next week, I'm beginning a new service, which is pretty cool. We are going to be doing the trade idea of the week, where I'm going to take a trending, and it could be bullish, bearish, or sideways, a trending security, and then every week show you how to be able to build trades around that. So we'll look at straight calls, both in the money, out of the money, straight puts, in the money, out of the money. We'll do, depending on whether the stock is bullish, bearish, we can do bull call spreads in and out of the money, bear call spreads in and out of the money, and also covered calls. But wouldn't it be awesome if you had somebody feeding you a trade idea every single week that would be actionable for you? So if you'd like to get more information on that, just leave us a message and we'll let you know. Otherwise, I hope you found this to be helpful. These are pretty exciting times, no question about it. And wherever you are, I hope you are doing well. Until next time, be safe. And God bless you all. Look forward to seeing you here in the very near future. Bye for now.